Overall, a positive budget, especially for the financial services ecosystem. 5 things stood out in particular. First, the proposal to streamline central KYC database. This probably will be the biggest development for the financial services ecosystem, because currently there are different regulators still with different approaches to customer onboarding. So the ability to get onboarded once and take benefit across regulated products and services would be a massive plus for the ecosystem, will speed up onboarding journeys. The second point is the creation of the startup fund of funds, AIF's outlay of 10,000 crore. Supposedly more than 90,000 crore has already been raised towards this. This is similar to the government guidance funds which many other countries have, and is a plus, potentially could be scaled up in future, because domestic pools of capital are still shallow in India, unlike global counterparts. We still rely more on global capital. The third is the recommendation to streamline and speed up the procedures and requirements for company mergers. Currently still we take much longer to close transactions in India. Of course, sectoral regulatory approvals are a given, antitrust is a given, but the Companies Act process is still a legacy of the past, the High Court approval, which is now tribunal approval. So time probably has come to look at M&A more as a contract, as shopping, where two parties decide and they can do on-spot closings the way it is in Western markets. This, especially the way the country is evolving in the early stage and mid-stage ecosystem, would be a great boon to deal closings, because also by the time one decides to do the term sheet and sign and closes, the global headwinds end up changing. The third thing which stood out was, of course, the insurance FDI cap increase to 100%. It has been a long-standing demand and will streamline entries, capital allocations without JV partner related aspects, because JV models have been good as well as bad historically. So a stellar, very good, very important move. And lastly, the proposal to set up a high level committee for regulatory reforms is very timely, and potentially can look at 2 areas. One, again, how to streamline a unified licensing framework, because today the business model in financial services space is across all regulators, and it creates regulatory cholesterol for market players. Multiple regulators, multiple businesses overlaps, and potentially this opportunity can be used to have a seamless entry exit, including on the M&A, coupled with the fact that maybe time has come to recognize India entries in the regulated space. And when I say this, it includes non-banks, fintechs, payment settlements, banks, asset management, SEBI, intermediaries, pension, insurance, everything, where potentially a threshold-based approach can be taken for automatic entries without requiring the process of taking government approval, looking at fit and proper conduct, etc. And beyond a certain scale, similar to the scale-based regulations for NBFCs, like a sandbox approach where parties get reviewed, and if it is discovered that they shouldn't be allowed to scale or should be allowed to descale, that's a far better approach than the current model, which is a license model for any entry in the financial services space. So overall, a positive budget and a great one for financial services sector. Thank you.